Here, this is the bids and the offers separated. Does everybody see the bids and the offers separated? Well, take a look at what happens in this phase here where the crosshair is. So what happens in this phase? What is that all about? If the bids and the offers are separated, we can all recognize the change in the bid offer book here. We can start to recognize how the bid offer is slowly but surely starting to work its way out. But what happens here? What happens during this phase here? There's a massive drop in the total liquidity. Now that's not going to show up as a change necessarily in book. It could be a massive drop in bids and a massive drop in offers. But what happens next? Well, that massive drop in liquidity should lead to a very sizable volatility shift. And that's obviously when the balance area was forming here on oil, wasn't it? The balance area at $89 a barrel was forming at that price. So there's a massive drop off in liquidity at $89. So that gives us an RGL, doesn't it? That gives us an idea that if there's a massive drop off in volatility, very much like we see when it comes into the oil inventory release, for example, what's going to happen next? Well, what's going to happen next, of course, is we're going to get a volatility explosion. Because why would the dealers drop all their liquidity on both sides? Because they're aware that there's going to be a price explosion. Think about it. If you're a dealer, you're going to be on the wrong side of every price explosion, aren't you? That's what dealers end up doing. If you're a dealer and the price explosion is going to go up, you're going to be short. If you're a dealer and the price explosion is going to go down, you're going to be long. So the one thing you don't want to do is get heavy long when the price explodes. So what happens is that you get into the idea of just dropping all your liquidity off when you know there's a price explosion coming. And what happens, of course, is when you know there's a price explosion coming, you're starting to think to yourself, right, where is it going to break? Now, obviously, in this case, it breaks north, and it goes from $89 all the way up to $89.75. There is a price explosion behind that move. So when we see volatility dropping off of a trade, we start asking the question, where is the volatility going? What is the volatility telling us is happening here? Because usually when you see an increase in bids, you see a decrease in offers. It's just the world of book trading. When we see an increase in bids, it means why would you increase your offers? Because you think there's two-way money. So you don't do that. If you increase bids side of the book, it's because you're trying to reduce your offer side as well. Your total liquidity is the same. If I reduce my bids to 10 contracts and I reduce my offers to 90 contracts, I've got 100 contracts in liquidity in the marketplace. I've still got 100 contracts liquidity, total liquidity, 100 contracts. So it doesn't matter how I go about that 100 contracts, that's how I make money. 90 offers, 10 bids, the price is probably going to fall. Correct? The price is probably going to fall. So when we see the bid offer changing, it's like, for example, in a horse race. If you see a horse at 2-1 and it goes into even money, all the other horses in the horse race should go out by the same proportion in terms of money, shouldn't they? The book is always facing an over round of maybe 10 to 15%. So obviously if the horse goes into even money, all the other horses, they can afford to let them drift out in price, because that's how you balance up. That's how a bookmaker balances up their book, is because they start offering some value on some longer priced horses. Well, that's how the dealer balances their book. That's how the dealer balances their book as well, don't they? They start offering a higher price for sellers. That's how they balance their book. They offer a higher price for sellers, and that then is called a withdrawal of liquidity. The price goes higher, and the sellers come in and take that bit of business off those higher prints. Now, this is how this oil's developed. Obviously, the price exploded north, and it stayed exploding north, and it was visible that there was a decision coming up because there was a big drop in liquidity. A big drop in liquidity. a big decision is coming up. And we can obviously start watching for what that big decision may be and then try and take advantage of it. We can start watching the book, we can start watching the deltas, we can certainly look at the value to know what the decision is probably going to be. But you'll see this very, very clear. We'll take another screenshot when oil comes into the inventory release this afternoon, and we'll take another screenshot to show exactly what that's all about. You'll be able to recognize exactly that big drop-off in liquidity. So when you see a big drop-off in liquidity, you'll be able to see that at the inventory release, and then the liquidity fills in behind the next move. The big volume, the big volatility comes from the low liquidity. And obviously that should be pretty obvious in terms of the theoretical reason why. If you've got 500 contracts on the bid and 500 contracts on the offer, it's quite difficult to move price up one tick or down one tick because you've got to get through 500 contracts to do so. Low volatility. If I've got 5 contracts on the bid and 5 contracts on the offer, and I decide to buy 50 contracts, the price is going to move quite a bit on that 50 lot trade. And obviously that means that the volatility on low liquidity is going to increase significantly. And that's something that I can watch for. It's something I can pay attention to. It's something I can trade against. I can watch that drop off in the liquidity total book to see that there is going to be a volatility snap at some stage. Liquidity, low liquidity equals high volatility. High liquidity equals low volatility.